Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. U.S. President Donald Trump has signed a permit for a new cross-border oil pipeline, reviving elements of the canceled Keystone XL pipeline project. The Bridger pipeline will transport Canadian crude into Wyoming and clears a key regulatory hurdle. The move comes amid ongoing trade tensions between Canada and the U.S., with officials saying it supports North American energy security. Shares of Imperial Oil are in the red by about 3.3%. That after the Canadian oil and gas producer posted profits for his first quarter that were well below what analysts were expecting. Revenue and other income also saw a decline compared to the previous year. Imperial also logged a drop in throughput activity and saw a decline in petroleum product sales due to lower volumes. And we are watching shares of TC Energy today. The Canadian energy company has approved a $1.5 billion pipeline expansion project. The move will expand its Columbia gas system that extends from New York to the Midwest and Southeast. It is expected to be in service for 2030. TC also reporting results for its latest quarter, where it saw a decline in earnings from its Canadian and U.S. pipeline operations and missed on revenue. And taking a look at the markets right now. The TSX, it is, it's not down, it was up, it's dropped back down below the red line, off by about 0.11%, back below 34,000. Tech was leading the way earlier. Taking a hit today is the energy index. And south of the border, they are solidly on the plus side, but they pulled back a little bit from the start this morning, but they're all, I shouldn't say they're all, S&P 500 right around record territory. Same with the NASDAQ, what a run April was for them. And the Dow Jones looking at 50,000, closing in on it again. Well, this was a big tech earnings week test. Now Meta, Alphabet, Amazon, Microsoft, and Apple all reporting in a two-day stretch. Apple was the latest to report, posting its strongest quarterly sales growth in more than 4 years. Let's get some perspective now from Nick Picard, Chief Options Strategist and Portfolio Manager, Hamilton ETFs. Nick, thanks very much for joining us.
Nice to be here. Thank you.
With Apple, what number stands out for you? Which one do you like the most?
Well, I think Apple mostly did well in their iPhone sales in China. I think that's what the market is reacting to today. And, that rounds up a very solid round of earnings for most of the tech stocks. You have to remember that these tech stocks now represent the five that, just reported, represent close to 25% of the total market cap of the NASDAQ and the large U.S. indices. So it really matters for the overall market.
Okay, and with Apple in China, what are they doing right there? What do you think was making the difference for them?
Yeah, I'm not entirely sure what they're doing exactly right in China, but it sounds like whatever they are doing is working. The one thing that you have to worry about for Apple is they are very, very dependent on their iPhone revenues, their iPhone sales, and the services associated with that. I think what the market is going to have to consider is what is going to be their AI strategy, because that's what all the other big tech companies are doing right now.
And they must have some concerns too about expenses, chips going up, and other concerns.
Yeah, no, absolutely. The costs of those are going up significantly. Is that going to squeeze margins? There is going to be some uncertainty associated with that, as there's more and more demand for these memory chips and these microchips.
So does that make, with all that, does the 17% revenue growth, is that realistic? Is that possible?
Well, look, I think that we don't particularly know exactly if it's going to happen. Of course, it's possible that it does add a lot of volatility. And what we see as option traders and option managers, what we see in the tech market right now is going to be substantially more volatility in the tech sector. Apple with their potentially, the costs pressures on that, but also the, more to the point on all the CapEx spending that's happening in Amazon, in Google, that's happening at Meta, and all of that CapEx spending means they have to use all their free cash flow, and that adds some balance sheet uncertainty going forward and adds to the volatility. So I think it's actually a good time to be looking at covered call strategies, which is part of what we do, because you're going to see higher elevated volatility in the tech sector going forward, and they may do great, but we're certainly going to see, I think, more volatility going forward, despite the fact that we still get new highs on a weekly basis, it seems.
And you cut out there. What was the alternative from the tech that you said in there? I just missed what sector it was or what section.
No, I was just talking about the AI capex that we're seeing and the impact that it has on overall volatility for the tech sector, and how you can basically take advantage of that volatility by monetizing it through covered call strategy. But you have to be really careful with trading options around earnings. That's one of the things I get a lot from options traders. For example, Amazon yesterday and today was up about $10 off of their good earnings, but that wasn't enough to make money buying a call option in Amazon. If you bought a call option in Amazon before their earnings on the close, the 265 calls, for example, and right now the stock's around 270, you think you would have made some money. But actually, because that volatility comes down after earnings, you actually broke even. You didn't make any money. So that's always something when you're trading options, that's something to think about, is what happens around earnings and earnings volatility.
And it's not always a guarantee, right? I want to go back just to Apple for a second. AI, where they seem, I think we've talked to people, they're late to the party a little bit, or it feels like maybe they are. Are they, and are they playing catch up, or have they caught up?
I think they can still play more catch up. The good news for them is they still have a substantial amount of cash flow that they can use to play catch up. I think the model for them is going to be to pair up with other AI providers for their iPhone and potentially work on their own solutions. But one thing's for sure is they're going to want to be part of this. It's certainly pretty clear now that the whole market is going to have an AI strategy, whether you're a technology company or not.
All right, and just one other I want to ask about, a lot of services they're turning to. Your thoughts on that growth there, the opportunities?
Yeah, I mean, I think that's going to continue. I think that's heavily tied to the iPhone and what services they can provide with that. I think it's a very large market share that they have, even though it's becoming tougher to maintain. But they're still very, very loyal customer base on the iPhone, and so I think that's something they can keep working on.
All right, Nick, we have to wrap it up there, but thanks as always for joining us.
Thank you.
Have a great weekend. Nick Picard, Chief Options Strategist and Portfolio Manager at Hamilton ETFs. Up next, Magna International has reported Q1 earnings that beat expectations on the top line. However, the stock is sliding. We'll break down why when we come back. Shares of Magna International are taking a hit even after they posted higher profits and stronger sales in the first quarter, beating expectations. Now, despite the solid quarter, the Ontario-based auto supplier is looking to trim its outlook, signaling a more cautious view for 2026. For more on this, we're joined now by Jonathan Goldman, diversified industrial analyst at Scotiabank. Jonathan, thanks very much for joining us.
Good morning. Thanks for having me.
All right, numbers. Which ones stand out to you?
Yes, I think you mentioned on the top, it was a nice performance on the quarter. It was a nice beat. It was mostly driven by the margins, but still well ahead of consensus. And, if you look at the stock price today, down pretty significantly at the beginning, kind of got some of that back. I think people and investors are probably probably looking through that beat, and they're kind of viewing it as a bit of one time. They did have a favorable commercial recovery in the quarter that kind of drove the beat. So if you strip that out, it would have probably been closer to inline results. Still probably doesn't warrant the stock selling off here. There's some reasons for that. But, based on where we sit today and our view of things so far in first take, we'd probably be buyers here on weakness.
All right. What's pushing the sell-off then?
Yeah, I think there might be some concerns about the guidance. So they lowered the guidance ever so slightly, about 1% on earnings, right? And if you look at the reason for that, it's not unexpected. Earlier in April, they sold one of their businesses that probably wasn't performing to the Magna standard. That's their rooftop and lighting business. So we always knew that the sales forecast and the earnings forecast would come down a little bit. I think what could be happening is people are reading too much into that and using it as kind of a harbinger of the industry may be more draconian than people think. And, maybe they think that oil is impacting car sales and we could see sort of a deterioration in the back half, but that's definitely not the case. They took down the volume, which is the key indicator here, by 1%. They more than made up for it with higher margins, things that they're doing, self-help levers. And overall, if you look at the earnings kind of guidance, it's effectively unchanged. So I think people are probably reading too much into this. It was expected. It was because of divestiture. And again, things look fine on our end.
And you mentioned with they're increasing the margins, self-help levers. What's that, and what are they? How are they helping?
It's a good question. So this is the old Magna story, use your scale, drive margin improvement. These are things what they call operational excellence, things like factory of the future initiatives, which is automation. It's just being more lean, doing more with less, improving productivity. So the old adage that we use in the industry is basic blocking and tackling. And they're doing those things to drive margin expansion. And the impressive part about that is they're doing in an industry where volumes are effectively flat. Usually volumes are the biggest drivers of margin expansion. They're getting it anyways just by stuff that they're doing on their own end.
And why? So why are they doing it then rather than with the margins increase? They're still going ahead with it even though the numbers aren't necessarily there?
I would say necessity is the mother of invention. It's never, not a bad idea to trim your costs. It's something you can always do regardless of what the macro is doing. I'm sure you can appreciate this. One of the more cyclical industries out there. A car is a big purchase with average prices now at $50,000. Gas prices are high. There's always things can go up and down in terms of sales volumes. We think those are fine, supported by wealthier consumers. But again, you don't want to have to just sit on your laurels and wait around for an industry to turn bad or good. You kind of always want to be looking for ways to optimize. They call it continuous improvement. And I think this is just part of the Magna culture, is always looking for ways to improve, expand margins, and do what you can regardless of what the auto industry is doing.
And now you mentioned oil's not necessarily a risk or a factor right now, but what circumstances might make that change?
Yeah, I guess the big circumstances would be level and length, right? At $100, for a few months, 4 months, not a big deal. If we go above 100 and we're at 130 for 6, 8, 9, 10 months, that starts to impact demand. And I don't think it would be exclusive to Magna or the auto industry. I think you would see it obviously broadly, across the economy. Mm-hmm. That's the big risk. I guess the thing I would say earlier, about wealthy consumers, if you're buying a pickup truck for $85,000, $4 a gallon of gas is not going to be a deterrent of whether you drive or get that vehicle.
And I think 85 is one of the cheaper ones right now, isn't it? Holy cow! I can't get over the price of some of the pickups.
Yeah,
what about CUSMA? The negotiations that are coming up. Any concerns with that, or what kind of an impact they might have?
That's a good question. So we've done a number of channel checks on this, and we've spoken to auto industry insiders. Our sense is the renegotiation will be focused on assembly rather than production. And what I mean by that is where the car actually gets assembled in the end, whether it's the US, Canada, or Mexico. I think there will be a push to bring more of that back to the US. But in terms of actually producing the components themselves, I think that is a relatively safe bet that stays where it is. You can imagine the cost and the time to shift production of a GM frame from Canada to the US is exorbitant. I've heard estimates in the range of $500 million to $1 billion per facility, and a minimum of 4 years timeline just to switch it over. These things are validated, tested, approved with numerous safety regulations. It is not a light switch to switch it over, and companies don't want to make these knee-jerk investment decisions when things could change, honestly, day to day. So we think assembly is more likely the thing that gets discussed rather than production or components, which is what Magna would be subject to.
And they wouldn't be are there any parts that they assemble to a point that might change, or is it mostly strictly parts?
It's mostly parts. They do assembly. Magna does everything in the car. But I think, at the end of the day, it's the OEMs in the US that would be the importers of record. They would be the ones that would pay the tariff. So you can just imagine it's not beneficial to the US economy if you're putting tariffs on everything that you import. The reality is, there's specialization in the industry. Some people do components, some do assembly, some do design. And you kind of want to have that specialized, and starting to put tariffs on everything doesn't really help anybody at all.
All right, Jonathan, we have to wrap it up there, but thank you very much. Have yourself a great weekend.
You too. Thank you.
Jonathan Goldman is diversified industrial analyst at Scotiabank. Coming up, Air Canada is pulling its financial outlook for 2026 as soaring jet fuel prices tied to the war in Iran rattle airlines worldwide. We'll get more on this after the break. Air Canada has suspended its 2026 financial forecast as higher jet fuel prices push up costs across the industry. Executives say the jump in fuel prices is starting to weigh on travel demand, even after fuel hedging helped blunt the impact earlier this year. Let's get more on this story from Matthew Dion, Montreal Bureau Chief at Bloomberg News. Matthew, thank you very much for joining us.
Pleased to be here.
So is the sky falling for Air Canada? Is this just something they're saying, look, we don't know what lays ahead?
Yeah, well, Air Canada's CEO, Michael Russo, said the pace of the fuel price increase is testing demand resilience across commercial aviation. So it's disrupting for sure, but it was expected that Air Canada would probably announced something last night about its guidance. Other airlines have done so. United Airlines slashed its full-year profit forecast over higher fuel prices. Delta Airlines decided not to update its full-year outlook last week. Air Canada decided to suspend its full-year guidance for 2026, but it did provide a guidance for the second quarter, giving an EBITDA range target that's below analyst estimates, but they did provide that. They expect the available seat mile to increase by up to 1% during the second quarter. That's a measure of capacity. Yes, it is testing demand, but travelers are still there. The demand remains strong, assured Air Canada yesterday as they provided their quarterly earnings. And the earnings for the second quarter were actually higher than expected. They beat analyst estimates. So it's quite a mix today where you wonder what's going to happen next, right, with the fuel prices. And on the other hand, they had a good quarter. They were able to offset the higher cost of fuel prices, about $90 million. And with hedging, they were able to bring back down to $55 million. But as we go in the second quarter and in the remaining of the year, if the fuel prices remain elevated, well, that's going to have an impact on financials because you won't have as much hedging protection during that period. But in the meantime, they're able to offset between 50 and 60% of the fuel expense through cost actions, fuel surcharges, for example. They've suspended some less profitable routes lately, 4 to JFK that goes daily to JFK from Toronto and Montreal. So they do some stuff to manage around this.
And are they expecting demand to continue? They had higher than expected demand. Are they expecting that will continue, or prices?
Yeah, well,
prices finally drive people away.
Yeah,
sorry, go ahead.
They're not seeing any changes in terms of pattern for now, as people are still willing to pay a little higher cost to keep traveling. So we're not seeing that for the moment. And so it's probably that explains why today we don't see the share price move much, because there's a lot of factors that are positive for Air Canada going forward amid this very, very challenging year. Let's remind, they had this accident at LaGuardia a few weeks ago where 2 pilots died. Michael Russo, the CEO, will retire at the end of September. So there's a lot of things going on for the airline right now.
There are the challenges, but I was just looking at some of the numbers. Record operating revenue, if I'm correct, record adjusted EBITDA, the swing on the operating income. So there is a lot going right. Will we get an update on the guidance sometime in the year, or is that it now when it comes to, because of the fuel prices, until that's settled, they're not going to
well, if the war in Iran, if the blockage in the Strait of Hormuz stops, you'll have a better idea where fuel prices are going. But for now, the swings are, it's so volatile, and it's so unpredictable. And that's what Air Canada said yesterday. And I asked Air Canada, could you give us a number? What's the extra cost for the full year that you're expecting from fuel prices, from higher fuel prices? And they were not able to provide that because they just don't know. They could provide me a number today, and in 2 weeks that number could not be right anymore. And so you don't want to influence markets on that front by providing a number that may not be accurate in 2 weeks. It's just so volatile right now.
Yeah, some challenging times for them. Okay, Matthew, thank you very much for joining us.
Thank you.
Matthew Dion is Montreal Bureau Chief at Bloomberg News. Coming up, how AI is changing the economics of advertising. We'll speak to the co-founder of an AI production company on why Canada is moving more cautiously than the U.S. That's ahead. Shares of Magna International are seeing some pressure after the automotive supplier cut its full-year sales forecast and scaled back expectations for light vehicle production in North America and Europe. On the upside, Magna reported profit and revenue in its latest quarter that topped estimates, with revenue jumping more than 3% compared to the year before. Shares of Agnico Eagle Mines are trading lower. The company beat on the top and bottom line in its latest quarter, benefiting from higher selling prices, but investors might be focusing on quarterly gold production falling compared to the same period the year before. Agnico also made the decision to leave its full-year gold production forecast unchanged. Chevron beat profit estimates in its latest quarter, helped by higher oil and gas prices. Energy giant says strong pricing and contributions from its Hess Corporation acquisition helped offset lower output. Chevron also continued to share buybacks, though executives say that they're holding off on increasing repurchases until prices stabilize. And taking a look at the markets, TSX after that big day yesterday, taking profits maybe today. It's up by about 0.1%. And south of the border, everybody kind of pushing towards that record territory, into record territory. You can see the NASDAQ, what a month it had in April, and it's up again to start May. Dow as well, also up, and the S&P 500 is into record territory as well. Queen One Studios is a Toronto-based AI production company working with brands and agencies to speed up and lower the cost of ad creation. In Canada, AI is common in pre-production, but fully AI-generated ads are still rare, especially compared to the U.S. Joining us to answer why is Queen One Studios co-founder Ryan Patterson. Ryan, thanks very much for joining us.
Thanks for having me.
Okay, let's talk about where AI is being used in Canada, and then we'll get into the difference between the two. But where is AI really starting to settle in when it comes to ads?
When it comes to ads, what we're seeing is we're working very much in the pre-production end. So we're doing everything from sort of storyboarding, animatics, stuff that's not being pushed to the full audience. So everything that happens in the early stages is where people are asking us for help in Canada.
So I sound old for a second. They're still doing storyboards, eh?
Yeah, I mean, we're starting. Well, what we're doing is sort of starting from an image, right? And then there's a kind of a revision process back and forth. So, yeah, it's a good way to kind of visualize, what a final ad's going to look like. And we're even now doing more animation to see how the beats in the ads land. And it's a good way you can kind of quickly iterate as well. And for testing and for those early stages, it's been helpful, and more agencies are going that route.
And what kind of a difference does it make time-wise, cost-wise? And I'm guessing there's jobs lost because of this too.
I think I think the jobs are shifting, at least on the pre end. I think the power here is, again, like being able to iterate very quickly, right? So if a client wants a different reaction, they can ask for a different reaction. We can provide them like 10 different looks, so by the time it does get to post-production, you've got the kind of reactions you want. You have a better look at how it's going to land. So that would potentially save time in the post-production end as well.
And then to the bigger picture, we're seeing ads down in the States. Coke has done them. There's been a couple of others during the Super Bowl, but not so much up here. What's the difference? Why are we lagging? Yeah,
I think in Canada, we're a lot more risk averse to, some of the legal questions, the copyright, the likeness issues that are happening. I think in the US, there's this, shoot for the moon, like let's just do it and see what happens kind of approach. I think here we may follow their lead. I think audiences as well are, they kind of fall on both sides, but there is a very vocal group of people that are anti-AI. So I understand why brands and agencies are hesitant to sort of go full out, but I think that's going to change as time goes on.
And how does it work with royalties when it comes to the images? Because I mean, AI is taken from human beings. If you see a human up there, it's modeled on a group of people or someone. How is all that working, and how are you working with that?
Right. Yeah. You have to be very cautious. People can lend their likeness if they wanted to, and you could work with it that way. I think, again, that is one of the big reasons why we're not going fully AI generated ads here. I think the copyright issue in the US, once you generate an image and you tweak it, you put a sort of human touch on it, I believe then it becomes copyright. I don't think those rules have been established yet in Canada. So we're going to have to wait and see there. But, generally, I think that this is why the hesitation, because we can't necessarily control all the outputs, the likeness, as the AI models kind of get better and mature a bit, we may be able to more confidently go in knowing that we're not stripping from someone's likeness.
And you say the rules here are lagging behind the U.S. to a degree. Are they talking about it even up here in government?
I'm sure they are. We're as a company that's sort of an AI native studio, we're waiting and watching. I haven't seen it. I'm obviously trying to stay on top of all the news and what's coming down from the top. But we're slow to roll out. I understand why. This is a big topic. It's going to affect jobs. It's going to affect a lot of people in serious ways. And so, I guess I applaud that patience. But at the same time, I think there's a lot of people who want to get moving. We want answers. We want to know, what's safe to use. And as audiences kind of start to maybe accept a little bit more, understand how it works, then I think we can kind of move forward more confidently.
And if we get some clarity on the rules and you start seeing like 30-second ads, something like that, or minute ads, how long does that take? How much cheaper is it than using a full crew to shoot it? What's the difference between the two?
Right. Well, I mean, I think this goes on. It's a sort of a sliding scale. A smaller company may, hire a couple AI artists, for example, to put together a 30-second ad, a 45-second ad, and put it online, where the risks might be a little bit lower. I think for the bigger brands, there's going to be a much bigger savings depending on, what types of shoots. Like if you're using a celebrity, for example, you might go on a hybrid mode, but that's still going to be expensive to pay those people. But generally, the whole post-production part of this is going to completely change because you may have a few people, on their laptops working through these ads and putting these ads together. So, if you can just imagine a massive crew of people that's being kind of trimmed down to do ads in this way. I think the time-wise, you can iterate faster, but from what we've been told, again, just having done a lot of the pre-production, there's there is still a time factor there. You have to do those checks and balances. You have to do all the revision work. So there is time savings, but I think it's not as instantaneous as people think. You're not just pressing a button to generate an ad.
And it's magically there. Okay, we have to wrap it up there, Ryan, but thanks very much for joining us.
Thank you very much.
Ryan Patterson is co-founder of Queen One Studios. When we come back, a new cross-border pipeline will transport Canadian crude into Wyoming. We'll break down what that means for the Canadian oil and gas industry after this. U.S. President Donald Trump has approved a permit for a new cross-border pipeline, echoing elements of the canceled Keystone XL project. The joint project between Bridger and Calgary-based South Bow will transport Canadian crude into Wyoming. For what this could mean for Canada's energy sector, we're joined by Heather Exner-Perot, Senior Fellow and Director of Energy at the Macdonald-Laurier Institute. Heather, thanks very much for joining us today.
Yeah, great to be here.
Okay, how is this going to unfold? What will this pipeline mean for Canada and Canadian oil?
Yeah, it's obviously bullish for the oil and gas sector. They're finding a huge new export capacity, probably about 550,000 barrels is the nameplate capacity, and certainly echoes the Keystone XL that had so many issues. The northern portion is exactly the same. It goes along South Bow's route. People don't know there's already about 150 kilometers of pipe in the ground from the last go around, but takes a different route on the south side through Montana and Wyoming.
And so it's partially built. And what about permits, everything like that? When can we expect this up and running, and how much is it going to cost, you think?
Yeah, on the Canadian side, it's already permitted, so we don't have to go through any more drama or any more cultural wars here in Canada. On the southern side, it is taking a new route, so it is going to need state permits. It's going through, starting the environmental process there. I think optimistic hopes are that it could get for a final investment decision and even up and running by 2029.
And will we? There's an extra, I think, half million barrels of crude a day possible through there. Is that demand there? I mean, we're looking towards Asia as possible markets. Will the demand be there to send it south?
Yeah, well, the market will say. I think people need to remember Enbridge has already discussed optimizing their mainline by 400,000 barrels. They're moving ahead with the first phase of that. Trans Mountain has said that they're going to expand by 360,000 barrels, and this adds another 550. So that's 1.3 million barrels. That's pretty significant. I think the real problem will be attracting the investment on the upstream. You're probably looking at $100 billion to fill all those pipelines. And so you need some positive regulations coming from the Carney government to attract that investment. But I just want to remind people, Trans Mountain wasn't even in service for 2 years, and it's probably full this month. So it seems like there's demand for Canadian oil out there.
But $100 billion on the front end.
Well, yeah, I mean, based on what we did in the oil sands last time, you can kind of compare a little bit what that capital investment is. Of course, these companies spend, a couple tens of billions of dollars every year already, but we do need some more money, probably some foreign investment money. And that's why I was also pleased to hear that Total, BP, Conoco are looking at some M&A possibilities in the Canadian oil patch as well.
Some reason for optimism. And going back to the government for a second, what does the government need to do on this? Is it just stability? Is that what people want to hear? Or do they need changes?
Yeah, we have an industrial carbon price for one. The nice thing about this pipeline and why you see it going ahead before that Northwest pipeline is because it doesn't come with the anchor of the Pathways Alliance carbon capture project. So this can just go ahead. As you mentioned, it's a pretty capital efficient pipeline. I think it's only $2 billion for that Bridger extension. And so this is, very attractive from an economics perspective, but we need that industrial carbon price to be clear. We need it to be positive. And I think to get, really fill up over 1 million barrels, we might need to see some of the, accelerated capital cost programs that we saw with the oil sands in that first phase a decade ago. And
does the industry have optimism for that right now?
I think everyone's on pins and needles waiting to see how this MOU goes out. And we heard a week ago, we should find out in 2 weeks. Carney obviously, wants to attract that investment, has talked about an energy superpower, but it's really the details that are going to make or break this.
All right, another pipeline to talk about, TC Energy. They got approves that $1.5 billion expansion in the U.S. Let's talk a little bit more about that, the impact of that.
Yeah, well, that's natural gas demand in the United States, obviously driven by electricity demand, driven by data center demand. So great news, for TC, probably a great bet. They foresee tremendous expansion in natural gas demand in the United States, in that heartland there. And obviously the MOU is also very important. So we get clarity on the Canadian side. Right now, people might not know, under the clean electricity regulations, it's actually criminal. It's under a criminal act if you wanted to build a new natural gas generating plant. But Alberta has cheap natural gas. We could be capitalizing on the data center investment boom as well. And that should be resolved with this industrial carbon pricing announcement that we're all looking forward to.
It's actually criminal to build a natural gas plant?
Yeah, it's under the Canadian Environmental Protection Act, the clean electricity regulations. And so that's obviously discouraged public sector, privately traded public boards from investing in new natural gas. But they've had promised a carve out in the MOU, and now we're waiting to see what that looks like in practice.
And is there optimism in practice this will work?
Yeah, actually, new TransAlta CEO discussed today, people are ready to pull the trigger. We keep talking about this pipeline, the Northwest Coast Oil Pipeline. There's other pipelines going ahead, and there's data center investment ready to pull the trigger. We really need that industrial carbon price framework to be settled very soon.
All right. And what are some of the other pipeline projects going ahead?
Yeah, so the mainline expansion, the Trans Mountain expansion, and it's still, Danielle Smith is still talking about, being a proponent and advocating for that Northwest Coast Pipeline, putting in their submission to the government by June. Still seems to be on track. The Minister of Energy, Brian Jean from Alberta, said yesterday they're actually having very positive discussions with Indigenous communities and are still hopeful that they'll be able to get consent for that port terminal.
And with the natural gas prices, any concerns up and down with, because they've been all over the place lately with everything that's unfolding along with oil. Is that a factor at all, or on these projects, or will they go ahead regardless?
Well, you see Enbridge, pulling the trigger, getting their approval for natural gas expansion with Sunrise in BC. You see TC Energy making this decision just today. So everyone anticipates the electricity demand is still going to grow, and it will require natural gas. We all know that. And of course, there's quite a few LNG expansions that are going to pull supply as well. So still optimistic. We're sending LNG, for 20 times more than we could burn LNG here in Alberta. And so there's a great business case for actually sending, the data instead of the molecules.
Okay, we'll wrap it up there, Heather, but thanks very much for joining us. Have a great weekend.
Thank you.
Heather Axton-Pirot is a Senior Fellow Director of Energy at the Macdonald-Laurier Institute. Coming up, shares of Moderna are slightly under pressure despite the pharma company posting the first quarter sales beat. We'll get you that chat with the CEO on growing demand outside of the U.S. after the break. Shares of Moderna are slipping even though the vaccine maker reported first quarter sales that more than tripled and beat expectations. Earlier, Bloomberg spoke with Stéphane Bancel, CEO of Moderna, who discussed growing demand outside the U.S. as Moderna leans on international government contracts to offset weaker domestic vaccine sales and ongoing regulatory headwinds.
Several years ago, we decided to diversify our geographic footprint by investment in long-term partnership outside the US with governments. We've done it in Canada, in the UK, in Australia, in Brazil, in Mexico recently. And you started to see the fruit of those investments. And so we're very pleased for that sales, mostly driven by UK for the spring season booster. And that's really in line with our strategy.
And if you take a look at your revenue, we're talking about $389 million. U.S. sales accounted for about $78 million of that. International sales were more than $300 million. We know that the way that the trajectory of the U.S. typically goes is that you see more COVID vaccines come through in the later part of the year. But you think about that breakdown, mostly international. Would you expect that to be the dynamic for your sales throughout the year, or will it sort of even out?
Yeah, I think you're right. It will even out. As you said, in the US, really, the fall season is when it's most important in terms of sales. What is great for us is we got a new product approved by the FDA, mNEX Spike, which is a new COVID vaccine with higher efficacy, higher antibodies to protect people longer. And so we are seeing very good market share penetration. Last year was the first year of launch, and it was not a full year of launch. in 2026, we're going to have a full year of launch in the US. And so the teams are working really hard to make sure that this product is available to protect people.
And you've had a lot of back and forth when it comes to the Trump administration with the FDA in particular. We know that a top FDA official, Vinay Prasad, is leaving. Of course, he's the official who overruled career scientists to really limit who can get your COVID vaccine. But with his exit, do you think that the regulatory environment for yourself and for other vaccine makers might start to improve a little bit when it comes to the U.S.?
If you look at what happened to us, last year we got a few product approval by the US FDA. We have very good discussions, and the working teams are doing a great job around the flu programs. We are waiting for more phase 3 data, and if they are positive, we plan to file them to the FDA as soon as we can this year. And so things are in a good shape right now.
Let's talk a little bit about some of the phase 3 trials and other trials that you have going on, because when it comes to Moderna overall, it feels like investors for the past few years have been wondering what's going to define your company coming out of the pandemic. There's a lot of excitement over a possible skin cancer vaccine that you're developing with Merck. The expectation is that you're going to have trial results this year. Is that timeline still possible? And can you give us any more detail there?
So yes, as you say, we have already transitioned the company from a COVID-only company product to a multi-product company. Already today, just in infectious disease, we have 4 products approved. As you know, we just got the flu plus COVID single dose approved in Europe as one product. It's a first in the world. But this year is a big year in terms of diversification away from infectious disease. And cancer, of course, is it. We confirmed today in the earnings release that we should have the phase 3 data for melanoma product this year. It's tough to be very precise because this is a study that is driven by a number of cases, people that have the cancer coming back, either in the arm with our drug or in the arm of a study with the standard of care, which is Merck's medicine alone. And so it's tough to be precise, but the numbers are accumulating, and we can confirm that it should be this year. We also have a potentially our first rare genetic disease clinical readout for a pivotal study for final approval registration this year as well. And that's another thing. So if you think about Moderna, by the end of the year, we could have up to 5 products approved. We have 4 today. And we could be a cancer company, and we could also be a rare genetic disease company. And so that's a broad diversification of a company. We started by discussing about the geographic expansion and diversification. So we're already going in both dimensions, geography and new product.
Absolutely. And when it comes to the pipeline, when it comes to the diversification that's planned here, certainly investors laser focused on that. And I know you just said that it's tough to be precise, and I hope I'm not getting too far ahead of myself, but, should that phase 3 trial go well for that skin cancer treatment, how soon could it win FDA approval after submission? Is there any sort of timeline that you can give me there?
Yes, I can give you a range. What we've shown in the phase 2 study is after 5 years, roughly 1 in 2 persons has an improvement versus the standard of care, Keytruda drug only. We're going to share that data on June 1st at ASCO, the big oncology conference in Chicago on June 1st. But if we get the data, we could assume we're going to be submitting very quickly. Merck and our team are already working on preparing the application, the manufacturing section of the application, the phase 1, phase 2, the preclinical data of the application. The only thing that's going to be missing is the phase 3 data that we can put in the file pretty quickly, file in a matter of a few months. And then we expect the FDA to go really quickly because, again, 1 in 2 people in the study in phase 2 benefited from the drug. And as you know, the survival rate in skin cancer over the long term is not good. So that could be a huge benefit for patients.
So we'll definitely keep an eye out for that on that point. But I do want to return a little bit to the U.S. COVID vaccine market before we let you go, because you know better than most that it's been a rocky road coming out of the pandemic. We've certainly seen uptake decline, and we know that, the health secretary has been particularly skeptical. But in your view, do you think that we've hit the bottom when it comes to the COVID vaccine market here in the U.S. and sales will increase going forward, or do you think that we're sort of in a new normal here?
So indeed, the vaccination rate has come down a lot. What you see is that people at high risk either because of their age, 65 and above, or because they have a comorbidity, they have another disease that puts them at high risk. That population has really stabilized, and we think that stabilization is going to be enduring. The other piece that I think will happen is that hopefully we get approval in the US down the road of a flu plus COVID combination product. I think it should expand the number of products that are available for people. So I could see the sales going back up over time. And as you know also, we have an aging population, whether it's in Europe or in the US. We have more and more baby boomers, more and more people getting older every year. And that population is increasing because, of course, life expectancy is improving. And so I can see that market reaccelerating over the years.
That was Stéphane Bancel, CEO of Moderna. Let's take a quick look at the markets on Bay Street and Wall Street, see how they are doing. On Bay Street, still off by about 0.15, just below 34,000, still low. Overall, it's been a good week, a good few weeks for it. And south of the border, similar situation up at green and ending the week up again. April was a smash-up month for the U.S. markets. The S&P 500 up today by 0.71. The Dow about a wash right now, and the NASDAQ well into record territory again. Market calls coming up next. Today on the show, we have Barry Schwartz, President and CIO of Baskin Wealth Management. His focus, North American large caps. And that is it for Morning Markets. Thanks for watching. We'll see you back here on Monday. Have a great weekend.